Well, g'day there traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me in this weekend market update. Today's date is Sunday, the 2nd of April, 2017. We have said farewell to the first quarter of the calendar year for 2017. We have finalized, obviously, the month's worth of trading for March. The markets themselves through the first quarter are relatively healthy. They were posting gains across the board on average, just above 5%, which is a really good way to start 2017. The reason for this video, however, is just to become, or at least to sort of give you a more sobering outlook. The reason for this video is because we're seeing a lot of, inflection points establish themselves and potential weakness moving forward. The reason for that is because we've seen again this tweezer top reversal taking place at this resistance area. We've got this exhaustion gap which has shown up at the beginning of March. Sentiment is extremely skewed to the greed side, and again, there's a lot of sort of mania occurring at this particular juncture, up and around these historical highs. On top of that, we've been calling for this pullback back into the rising 50 exponential moving average. That has occurred across the board. Really on Monday, on the Dow Jones Industrial Average, we began to sort of push below that intraday. We were expecting, again, the buy the dip crowd to show up and to support the market around that rising 50 exponential moving average, and of course, to see this bounce eventuate. Now, fast forward Monday through Friday, the markets were relatively strong. They were relatively healthy. We've been expecting this. You can see the same picture taking place on the S&P 500. Both the S&P and the Dow Jones Industrial Average ended with sort of hybrid shooting stars, almost gravestone dojis. You can see also here an inside day spinning top on the Dow Jones Industrial Average. But the only difference really from this picture or between these three markets is that of the NASDAQ. Now, the NASDAQ is obviously on the precipice. It's on the cusp of breaking out. However, the Dow Jones Industrial Average and the S&P 500 is quite a ways away, I should say, from the respective swing high and the resistance level. So if you pay attention to the NASDAQ, even though it is back up around those historical all-time highs, it's actually printed intraday swing high. You can see that once again we establish what we call a shooting star candlestick. Now, what we're looking for in terms of buying this market, or at least becoming confident in the sustainability and the legitimacy of this intermediate and macro trend continuing to the upside, is that we want to see these markets break out in agreement. And obviously it appears that the NASDAQ is going to be the first of the three to actually give us the green light of markets moving higher. However, I wouldn't be jumping into the NASDAQ, and I really wouldn't be buying this market or buying into the Qs aggressively until we see the industrials and the S&P 500 close above their respective swing highs, and to see a continuation in agreement with the NASDAQ 100. Because really the reason for this particular weekend video is that the probability and the likelihood of some larger sort of material pullback is starting to sort of rise incrementally based on this sideways consolidation. The longer this progresses for, and the longer we see some of these divergences develop, and at least the lack of grid and traction on this next subsequent push higher, again, the higher the probability that we are going to see a rejection up and around these respective levels, and to see the market ultimately start cracking these inflection points which have established themselves during the intraday trading session on Monday. So let me explain this for you. Again, I am rather cautious on this market. I'm sort of disconnecting myself again from, I guess, the sentiment out there and a lot of greed floating about in the markets and what we're seeing in the financial press or what's being reported about. It's as if, happy days are here, so to speak, and that is really showing up in a lot of sentiment reports across the board, which have been sort of, factored this way, or at least focused this way, centered this way, for a number of months right now. What is happening in the actual picture is that we're setting up these what we call tweezer top types of multi-day patterns. We've got an exhaustion gap which has technically filled towards the beginning of March. Mid-March, we saw a bounce which produced another secondary lower high. We've seen that swing low taken out. We've just printed another fresh swing low, and now subsequently this bounce which we've seen Monday through Friday, the week just passed, in the closure to March 2017. A lot of people, again, jumping in and buying the dip. Let me be very clear, very precise as to how this market is going to play out. Either all three markets are going to break above their respective swing highs, and that will be fine. We'll jump on board with the bullish continuation. However, if we get these bounces, which even take out these swing highs in mid-March, 2017, the month just passed, if we see even the S&P 500 come up to just shy of 2,400, we see the Dow Jones Industrial Average get back up just above 21,000, and if we start to see then a series of bearish candlesticks coupled with, of course, some of these divergences which are taking place, well, then I would be very, very suspect on, the potential of a whipsaw, or what we call a false breakout up and around these resistance areas. The reason reason for this is because we have been in that sideways consolidation. The exponential moving averages are starting to flatten. They're beginning to move sideways. When we start going out on larger fractals, you can see on the weekly charts right here, you can see these oscillators which are technically triggering sell signals. You can see it developing on the Dow Jones Industrial Average. You can see it on the S&P 500 again, which is a different chart, obviously a different market. And here on the NASDAQ, we've got the same signals. I mean, we can remain like this sort of indefinitely, so to speak. But again, the candlestick showing up, and I guess the sort of slight bifurcation at this particular point of these markets, at their recent high or near or very close to their recent resistance swing peak, which is on the NASDAQ compared to that of the industrials and the S&P 500, where we're starting to see divergence happen. And again, if we start going out on larger fractals, and let me just take the annotations off the screen for this, you can see that we're also printing divergence. You can see price again, parabolic break to the upside over the past 3 months or so. You can see the S&P 500. You can see these divergences developing. And again, when you start looking at this on the monthly time frame, if you go back in history, the same types of signals have set up since the turn of the millennium over the past two market peaks, the two market peaks in 2000 and again subsequently in 2007-08. Again, it's very similar to the current picture which we are looking at, and I don't want people out there to be sort of taken off guard if you see these markets rally and then to see a very strong sort of reversal take place and ultimately some more selling pressure. Whether or not that is a macro top or an intermediate top, time will tell. We'll have to move with it in the analysis. But again, I just want to forewarn you about a very possible, a very real scenario which may play out. And again, what we have established over the past, Easter Monday's trading session is that we have made the inflection point. And I use the term inflection point because, again, this is the swing low point where, we've got max support or support is stretched at its peak. So, I mean, if we start printing below this little swing low on Monday, you can see my trigger here on the Dow Jones Industrial Average. It's sitting at 20,374. Again, on the S&P 500, if you take into consideration that rising 50 exponential moving average and the intraday reversal which took place on Monday, you can see it's printing at about 2,314. So again, whatever happens in between these two sort of support and resistance areas, it's what we call market noise. You really shouldn't be paying all that much attention to it because, again, the probability and the likelihood of market volatility to see some pretty impressive up days followed by pretty sudden sell-offs is quite high at this particular point. It's not until we start printing above or below these extremes as to where we can really find confirmation across the board on these markets. And if I had to choose between one of these two triggers getting triggered at this particular point based off the technical signals, first of all, I'd like to see the long-term trend continuation. That would be fantastic. But I guess the realist in me, based off the technical picture right here, is that we are going to find some form of an intermediate top around these two resistance swing points. Maybe we overshoot it ever so briefly and then see this really pull back considerably. But again, based on those divergences and again, the negative volume, not the negative volume, but the negative momentum behind this, these markets across the board, coupled with the simple fact that the ADX doesn't like this bounce and the CCI, which is printing below that positive 100 area. You can see this on the Dow, you can see it on the S&P, the ADX turning down on this bounce over here. It leads me to believe that, again, the bears are going to be in control of this market potentially, but we're not going to trade it until we start seeing some of these structural levels, I guess the foundations of this bull market advance, begin to be taken out. And again, I've just walked through some of these inflection points, the best that I can give you at this particular point. There is the likelihood and probability that I will be able to bring some of these triggers up at a later date, but right now, as at Sunday, the 2nd of April 2017. That's the best we have. I'm not expecting them to trigger this week. I'm not expecting this whatsoever. Again, I'm expecting a slight bullish continuation to the upside. But again, you want to remain neutral up and around these resistance swing points because there's a lot at stake on this market. And I want you to be prepared and also warned about the very real probability and potential of this market taking a really severe nosedive, or at least a material pullback, which will turn out to be a lot more aggressive than what we have seen throughout the majority of March 2017. And I don't want you to be taken by surprise by the potential of some very strong and aggressive selling pressure, which flows and floods the market in April and also May 2017. So on that note, everyone, I think I've made my point very clear. Again, in many ways, it's like a contingency plan, so to speak, moving forward as we look at these markets. I'll update you in due course as to the developments, technically speaking. But if you'd like to learn more, have a look at Pro. That class is up online on the website. I'd encourage you to learn more about how we actually apply, technical analysis to the financial markets. We broke down also the Russell and the Dow Jones Transportational Average this week. We went into the US dollar, gold and silver, and as you can see on the left-hand side of my screen, our top 12 individual trade list. So on that note, everybody, enjoy your Sunday, and I'll see you during the week with some more inter-market or intra-week market updates when, of course, the market justifies me to do so. So on that note, enjoy your weekend, and I'll see you in due course. All the best. Goodbye.